Going into this year, investors were highly confident about the direction of the U.S. economy. Futures markets showed a 76% probability that the Federal Reserve would lower interest rates. For the average consumer, that expectation meant cheaper borrowing costs for mortgages and auto loans. The economy appeared on a smooth, predictable glide path. Then, the escalating conflict in Iran sent an immediate, violent shock through global oil markets. The immediate financial consequence of that disruption is a severely delayed timeline. Rate cuts that markets originally anticipated for June have been pushed back, likely to September. Some forecasts now account for extreme risk, calculating the possibility that the Federal Reserve keeps interest rates completely flat for the entire year. For policymakers, an oil spike triggers a chain reaction across the entire economy, beginning with the immediate sting at the gas pump. It acts as a dual threat anomaly that pulls the broader economy in two opposing directions at the exact same time. A single geopolitical spark in the Middle East threatens to reignite inflation while simultaneously stalling out economic growth, trapping the Fed in an impossible dilemma. The first trajectory of an oil shock points directly towards the hawkish threat of resurgent economy-wide inflation. Energy costs serve as the foundational layer for physical goods. When it costs more to power the massive industrial plants that smelt raw industrial materials like these aluminum ingots, those price shocks transfer directly into the final product. Right now, the baseline for overall consumer inflation sits moderately elevated at 2.4%. Consumer inflation is a measure of the average change over time in the prices consumers pay for a basket of goods and services. If crude prices remain high, the compounding cost to produce and transport goods will act as an uncontrollable invisible tax, surging that 2.4% baseline upward across every sector. But there is a second, competing trajectory to an oil shock, the dovish threat of a severe recessionary stall. Surging gas prices act as a direct and unavoidable drain on everyday consumer wallets. Feeling that immediate pinch at the pump, Americans react by quickly cutting back their spending on non-essential items. That creates a knock-on effect for businesses. Facing lower consumer demand combined with higher operating costs, companies hit the brakes on any plans for expansion. That uncertainty immediately bleeds over into corporate hiring cycles. This minimalist bar chart visualizes the stark reality of the current U.S. labor market. It highlights a weak downward trend, with the country adding an average of only 17,000 jobs a month. That weak hiring data is colliding directly with a rising cost of living. If the oil shock persists, the resulting drop in consumer spending and corporate hiring could drag a fragile economy into a prolonged, painful stall. Why doesn't the Fed just aggressively hike interest rates to kill inflation, like they did following the 2022 Russian invasion of Ukraine? In 2022, the U.S. economy possessed robust armor. Unemployment was below 4%, job growth was booming, and consumers had stimulus cash. Today's environment is far more vulnerable. Fiscal support has diminished, and the labor market is remarkably soft. The stakes are entirely different. The 2022 shock hit a booming, armored economy. The current Iran shock is striking an economy that is already walking a tightrope. The textbook monetary policy response is for central banks to simply look past short-lived energy shocks and focus on underlying economic trends. This animated breakdown illustrates how policymakers calculate core inflation. It strips highly volatile food and energy prices from the headline number to reveal the true baseline of consumer demand. But the grueling multi-year fight to drag inflation down from its 9% peak has left Fed officials defensive and scarred, as this isolated core data line stubbornly resists returning to their 2% target. As a result, the Fed's benchmark interest rate is currently sitting frozen, elevated between 3.5 and 3.75%. The benchmark rate is the foundational interest rate used by the Fed to influence all other borrowing costs in the economy. We are now in a high-stakes waiting game. If the conflict ends quickly and oil prices drop, the central bank can safely resume its rate cuts. If the conflict drags on, the Fed is completely paralyzed. They cannot cut rates without risking explosive inflation, and they cannot hold them without risking mass unemployment. All market attention is now hyper-focused on Chairman Jerome Powell's upcoming press conference, searching for any hint of which path will break first. Until the geopolitical dust settles in the Middle East, the trajectory of the entire U.S. economy is held hostage by the price of a single barrel of oil.